Welcome to the London Digital Podcast. I'm your host, Chelsea Banks. It's my job to take you inside the minds of entrepreneurs and deconstruct why they've been successful by understanding their thinking, habits, logic, and overall approach. I'm very excited about this convention you are about to hear. I had a great time. It is with Khuram Dhanani. He's a well-known digital entrepreneur and investor. He's successfully built, acquired, and exited various internet companies over the last decade in the digital industry. He originally founded a company called ClearSpark. It is one of the fastest growing B2B e-commerce companies, and it provided infrastructure to many of the largest internet retailers in the world that you and I buy from every day. ClearSpark was successfully acquired in 2014 by a Chicago-based private equity group. Before he founded ClearSpark, he founded another company called ZQ Network. It was a B2C e-commerce company that operated in a wide variety of niche markets online. ZQ Network was successfully acquired in 2012 by multiple strategic buyers. He has been featured in high-profile publications such as Forbes, The Huffington Post, Tech Cocktail, Incorporated magazine, and so on. So, let's get right into it. Khuram, welcome to the London Digital Podcast.
Thank you so much, Chelsea, for having me. It's great to be here, and I look forward to discussing with you.
So, tell us a little about how you got into the digital world.
Well, that's quite a long story, actually. The way I got into the internet marketing space was when I was really young. My parents were in the jewelry business, and so I asked my mother at the time to bring home a few products that I could list online. Back then, Yahoo Auctions, which isn't around anymore, and eBay were the big two auction sites. And those were the easiest places to get started on back then because you didn't need a website, you didn't need too much marketing know-how, you didn't really need a lot of development skills. You pretty much listed products, paid their fees, and it was pretty low risk because most of the fees were on the back end. You know, they call them success fees, where you pay them if they're successful. And I still remember to this day, one of the products that I had listed was a sterling silver ring, and our cost on that was $6 or $7. And I remember selling it for $42. I'll never forget the number. And that's when I had that aha moment where I could buy something for $7, sell it for $42. It sounds so simplistic, but the light bulb kind of went off, and I was like, wow, I just have to scale this now. I just have to repeat these transactions over and over again. So was very ambitious, so brought in more products, found dropship suppliers to start working with us, and built up a pretty solid business back then, originally on Yahoo Auctions, which again isn't around anymore, and then it was eBay. Then I had the thought, well, you know, if I keep selling on these platforms, I don't actually own the customer. I'm not really building any equity here. I didn't call it equity at the time. It was just sort of a natural instinct to think, well, I don't own the customers. I can't contact them. I can't upsell them. I can't remarket to them. I don't have any real assets here. And again, back then I wasn't really thinking in terms of assets or equities. It just kind of didn't make sense to me that eBay and Yahoo would own the customer and I was doing all the work. So very quickly shifted away from the auction model and started building our own websites. Made a lot of mistakes, hired a lot of designers, a lot of developers. Today, there's so many off-the-shelf platforms where you can just get a website up and running very quickly with no development skills, no programming skills, no design skills. Back then, it wasn't so easy. OS Commerce was the big platform back then, which, you know, wasn't much of a platform at all, but that's what we had to work with. So made a lot of mistakes. After getting the first website up, you know, the next task was, okay, how do I get people to it? When you list on auction websites like Yahoo and eBay, you don't really have that problem. There's already millions of people shopping on those websites every single day. When you build your own website, then you have customer acquisition cost. So I started in SEO, which is basically search engine optimization. And all that really means is you try to rank higher on Google and try to get people to your website without actually paying for the traffic. And that kind of made sense to me because the pay-per-click model is quite expensive. A lot of companies actually break even or use it as a loss leader. And we were going up against some really big jewelry companies at the time. So, it would be really tough to buy a lot of paid search, pay-per-click type of traffic because they could pay way more than us. Their product costs were lower than ours. So we were up against a lot of obstacles. So SEO made the most sense. Again, hired a couple different SEO companies over the next year or so, kept getting burned, kept getting, just agencies and people that talked a good game, but never really delivered on what they said. So I said, okay, I'm going to actually learn SEO, and spent a lot of time in forums and hiring people and on freelancer websites. Odesk and Elance were the big ones back then. They've now merged into Upwork. But basically learned the whole SEO game and learned what its essence was about and got pretty good at it. Back then, the algorithm was much easier to work with than it is today. Back then, I could basically rank a website, a relatively new website, within typically 3 to 5 months for pretty difficult keywords. And that's very, very difficult to do today. But back then, I just had mastered this art of SEO. And that kind of led to the genesis of ZQ Network.
Great. So what were your early entrepreneurial ventures like?
Well, my early entrepreneurial ventures were very much like my ventures are today, just the scale and magnitude has changed, but the core models that I was following back then were just business 101 things. I mean, I'm very, very risk adverse. So I'd always look for models where your customer acquisition costs could be lowered as much as possible and ideally free. Now, it's never really free, but as low cost as possible was kind of the idea behind a lot of my early ventures. And high margins were obviously very, very important. So combining low customer acquisition costs with high margins and then the ability to scale. So I always try to avoid markets or models where even if you're successful, your upside is so limited because you can't scale enough. So if a venture meets those three criterias, it's pretty interesting. So in the early days, again, a lot of it was on the auction websites. Today, I don't put any focus on any of the auction websites, but back then, it just seemed like the best place to start. So again, started off selling jewelry, and a lot of it was sterling silver jewelry, then loose stones, cubic zirconia jewelry, that kind of thing. Originally just some products from my parents' store, and then it turned into actually getting dropship suppliers all around the US and selling those types of jewelry products. Shortly thereafter, what I found was on any of these websites, they would actually show you all the data of products that had previously sold in the last 30 days. So for example, I could go into any category, whether it be automotive, baby products, jewelry products, fitness products, whatever the category was, and all the data was actually there. Now, this was pretty mind-boggling because I could literally see what sold in the last 30 days, how much it sold for, and how much of it sold in quantity. So it doesn't take that much intelligence to simply say, okay, I'm going to sell the stuff that's already selling at good prices. So that's kind of where I went next. I went into credit repair. I went into Forex, which is just foreign exchange currency kind of trading. And I went into hosting, web hosting. I just went into one market after the other, saw what was selling previously. And again, not reinventing the wheel here. That's, some entrepreneurs, that's what they do. They come out with some great innovative idea. That's never really been what I've been focused on. I've always really looked at what was already working, seen what was successful, and tried to do the same thing with my own twist on it. So I basically saw that credit repair kits were selling, and Forex software that helps foreign currency exchange traders trade currencies better was selling really well. And then the last thing I noticed that was selling really well was web hosting packages. So one after the other, I went into these markets and basically sold what was already selling. The web hosting story is interesting because that actually turned into a company called Hostwaffle, which was acquired by another small business out of Kansas. A Silver Web Design Agency acquired that. But basically what I did there was I noticed that people were selling web hosting packages for, $10, $15 a month, something like that. But in the early days, it was really hard. It's not like it is today. Again, it was super hard to get a website up. I mean, you could get it up. It would just cost a fair amount of money. It required certain skills. So I hired a developer to put together a bunch of turnkey websites. And the idea was we'll give the website away for free and we'll charge for the hosting package. So we rented out servers and our hosting costs were very, very little because most of these websites were getting almost no traffic to speak of. And the model there was we'll give away the website for free, which, theoretically is worth thousands of dollars. But I had a one-time fixed cost in getting those websites built out because, again, I hired a designer and developer, and that was just a one-time fixed cost, and I could give them away thousands and thousands of times. So the idea was we'll give the website away for free, and we'll charge $120 for the web hosting package. You'll pay for a year up front. So it turned into a recurring annual kind of model. And it sold like crazy because the way people looked at it was, I've got to get the web hosting package anyways, and here I'm getting a free website with the web hosting package. Again, super high margins, super low risk, and the ability to scale was there. And again, that venture just took off and followed similar models in credit repair and in Forex software as well.
And how did you get the idea for ZQ Network?
The genesis for ZQ Network actually comes from two different things. The first one is the SEO route I kind of told you about earlier, where starting off on the auction websites, the next level to that was building out my own websites. And then the obvious question came how to get traffic, which was SEO. So when it comes to SEO, one of the things that you do in that space is you look at keyword volume. And keyword volume basically tells you how many people go to Google in any given month and search for a particular keyword. Now, this data isn't always 100% accurate. There's a lot of limitations to this data, but it gives you a rough sense of what people are searching for. Now, the reason search is so important is because it's kind of the holy grail of marketing, the way I look at it. Because if you run banner ads or do social or PR, the way I think about that stuff is more outbound. You're telling people, hey, this is what I have to sell. Do you want to buy some? With search, it's the other way around. People are actually going to Google and they're typing in what they want, and then you just happen to show up. And so that to me was super, super powerful, and it still is today. So that's part of the genesis. And then the other part is two different companies. One of them is called Hayneedle, which was recently acquired. And the other one is CSN Stores. It was called back then. They rebranded themselves to Wayfair and had an IPO. The interesting thing that I noticed about Hayneedle and CSN Stores at the time was both of them had built these super successful e-commerce companies, but they weren't really carrying any inventory. They followed the dropship model. And so they would get an order, they would pass that order on to a supplier, the supplier would ship that product directly to the customer, and the customer wouldn't really know any different. They would think it came from Hayneedle or Wayfair. The reason that was so interesting is because my aversion to risk. I hate risk. I have a gut-wrenching reaction to risk. And so the idea of not having to carry any inventory is very interesting. The idea of being able to generate free traffic from SEO, which, by the way, isn't really free because it takes a lot of time, effort, energy to get that traffic. But just for argument's sake, being able to get free traffic from SEO and being able to not have to carry inventory and not have that risk. Both of those things combined seem like they were like a win. Like, there's no risk, there's high margins, there's free traffic, you don't have inventory risk. And I had already learned how to do SEO really, really well. Had built out a team in India, built out a team in the Philippines. So I had the team ready to go, had awesome web development team in Eastern Europe. So everything was ready to go, and these things all sort of just came together. So that's how ZQ Network was born. We started in the gift space, so gourmet gifts and gift baskets and that kind of thing. Then branched out into the baby market, then the fitness market, then the power equipment market, then the wedding market. And the idea with each of these markets was pretty much the same thing. The idea was, okay, you build up a website, you stock products on the website that you don't have to actually stock in real life. You don't carry that inventory. And then you rank those websites for keywords that people are typing in. And people type in those keywords, they come across your website, they buy something, the third-party supplier ships it, and you just keep doing that over and over again, and it worked. Back then, the Google algorithm was so much easier to work with. So we would launch these websites and be able to rank them within 3 to 5 months. The other thing I forgot to mention was, with ZQ Network, I realized that I wanted to move quickly. I don't have a lot of patience, and I've always moved very quickly with my ventures. I just don't have the patience. And SEO can take sometimes 6, 9, 12 months to really rank really highly for super difficult keywords, the really valuable keywords. And I didn't really feel like waiting 12 months for a keyword ranking, especially when there's volatility in keyword rankings and anything can happen with the algorithm in 12 months. So what I did was I went out and started acquiring other companies that were somewhat established, but they were small mom and pop kind of companies, hadn't really taken off. They had these distressed assets that they weren't really taking full advantage of, mainly because they didn't really understand SEO, or they weren't super motivated or ambitious to really build something great. And they just had these great domain names, these great website properties. So what I would do is I would go out and I would strike a deal. It took a lot of approaches before a deal was actually made, because most people said no. And the prices I was willing to pay were pretty conservative. And so it took a lot of cold approaches before somebody said yes. But the deal was that we will buy your website and we will pay you a very nominal fee for it. But we'll buy the website, we'll buy the domain name. And once the acquisition goes through, the next day we literally shut down the website. We have the domain name and we launch a new website with a fresh design, fresh products, fresh logo, fresh branding, all that good stuff. The reason to acquire that asset was because it already had history. The domain name was old, and Google was already ranking it somewhere in the top 10 pages was kind of like the criteria. So for example, let's say I wanted to rank for the keyword gift baskets. Well, I could start a website and spend 12 months trying to get it to rank on the first page for gift baskets. Or I could go out and acquire a website that was already ranking, say within the first 10 pages of Google, pay a nominal fee for it because the website wasn't making much money, and then just tear down the website, keep the domain name, 301 redirect all the key pages, and put up a brand new website. And within 3 to 4 months, I could get something like that to rank and start bringing in a 6-figure income. And basically repeated that process in all these different markets I mentioned: gifts, wedding, baby, power equipment, fitness, and so forth. And that's what became ZQ Network. The reason I exited that company was because,
That's interesting. And what was the core business model of ZQ Network?
The core business model for ZQ Network was really that of a traditional internet retailer. We sold products just like any other internet retailer did, but they were very niche specific. So I would never build out a website that sold a very generic line of products or sold pretty much every product under the sun, like say a Amazon or a Jet or a Wayfair or a CSN stores at the time or anything like that. I just didn't have those kind of resources, and I felt like specializing was more important than going for like the mass market. So the core business model basically was we'd build out a website and focus on a very specific niche. I'll talk about our first niche, which was the gift basket space. So the niche was gift baskets. It's a great niche because the gross profit margins in that niche are north of 40%, and that's for a drop shipper, meaning we're not manufacturing, we're not even stocking the product, we're simply asking someone else to drop ship it, and our margins were over 40%. The other reason a niche like that is so good is because if I ask you to name a brand of computers or a brand of phones, you might say something like Apple and Samsung, or you might say Sony or something like that. If I ask you to name a brand for gift baskets, you're probably not going to come up with anything. And if you do come up with something by chance, it might be one or two brand names, but there's no real core brand names that dominate mind share in that kind of market. So those are the kind of niches we went after, where there's no major brand name. It's not something that you would really buy in a store. It's a very convenient online product. It's something that can be drop shipped. It's something that has great margins. People are brand agnostic when they buy it. And basically, if all those things come together, along with good keyword volume, good search traffic, reasonably decent competition, so it's not overwhelmingly competitive, and the ability to rank keywords relatively quickly, if all of those factors kind of come together, that would be a niche that we'd pursue. And we, again, did 5 or 6 different niches like that. The core model, as I talked about earlier, was basically getting free traffic through search engines. Now, that's not all the traffic we got. We also did PR. We did a little bit of social as it was taking off. We did email marketing. We did a lot of other stuff also. But the core business model from a traffic standpoint was definitely free SEO, search engine traffic, and then shipping products through third-party suppliers. That was the core model. And I exited that company after I had kind of, I don't want to say capped out, but we were in 5 or 6 different markets. Things were growing, things were progressing. And, you know, it's like if you ask a world-class athlete, say in the NFL or the NBA, why did you zig left instead of going right? And why did you go that way instead of that way? And why did you pass instead of doing this? It's more instinct. They can't really tell you logically why they did it. I mean, I'm sure they have a logical reason, just like I did, but it's more of an instinct. It's more of a gut instinct. So before the podcast, you kind of asked me, why did I exit? And the answer is, it's a gut instinct. It just felt like the right thing to do. It felt like the business had gotten to a point where it made sense to sell. I just go with my instinct in a lot of cases like this. I can tell you the logical reason as well. The volatility with search traffic, new competitors coming into space, niches becoming overcrowded. There's a lot of logical reasons, but at the end of the day, I listened to my gut instinct, and my instinct was saying it's time to sell. And we worked with multiple buyers and got great offers on a lot of these properties. And I ended up exiting that company, and that was ZQ Network.
So, did you take any time off after exiting ZQ Network, or did you jump straight into ClearSpark?
That's an interesting question. So I have a very hard time taking time off. It's not something I do well. One of the things I've learned is when you're building a company, or even putting entrepreneurship aside, when you're doing anything that you're trying to be great at, whether it be athletics, whether it be business, whether it be the arts, or anything that you're trying to be great at, it requires a tremendous amount of focus, energy, dedication. I've never had much of a balanced kind of life in that sense. So what I found is, if you approach life that way for an extended period of time, and say you have a liquidity event and you get to exit your company, or some other sort of event that happens, it's kind of hard to wake up the next day and just stop. It's like if a car's going 100 miles an hour, you don't just slam the brakes and stop. It's just very difficult to do. So the answer is I really didn't take any time off after exiting ZQ Network. I did some consulting here and there. I worked on some small projects here and there, got into investing a little bit, but I never really just went on a vacation or just turned everything off and just took it easy. Looking back, I really wish I would have done that. I feel like I would have been better off for it. I would have been more rejuvenated. I would have been more recharged, maybe come from a different mindset, felt fresher, more energetic. But I just have a really, really difficult time doing that kind of thing. And so yeah, I never took any time off. I just went to work the next day. And but as far as ClearSpark goes, I didn't jump straight into it. The idea for ClearSpark didn't come until roughly 2 years later. After selling ZQ Network, basically for the next 2 years, I did a combination of things. I worked with the buyers on making sure there was a successful transition, making sure I was available to them, making sure they had everything they needed from me. I got into investing a little bit around this time, investing in equities and that kind of thing. Maybe we'll talk about that later. But so it was a combination of working with the buyers, investing a little bit of the money I had gotten, and also doing some consulting here and there. And the time just flew by and I had a great time. But ClearSpark came about 2 years later.
Sounds like every entrepreneur I know. Tell us about how you got into the idea of ClearSpark.
Well, that sounds like a lot of entrepreneurs I know as well. I guess it's in the genes or the DNA or something, but that's pretty much how a lot of entrepreneurs I know operate. And I've talked with many of them and I've gotten very, very similar feedback. So I guess it's a common trait. ClearSpark is quite interesting. So at this time, I had noticed a lot of e-commerce startups, a lot of internet retailers were starting up, but they weren't really following the traditional model. They were more focused on social buying. So let me just distinguish the traditional model from the social buying kind of model. Traditional model of an internet retailer is you basically have a store. It's either a generic store or it's a niche focused store, and you have products for sale and people come and they buy them, and it's very straightforward, much like you'd walk into a traditional retailer offline, into a brick and mortar kind of store and buy something. That's pretty much what every internet retailer was up until this time. Then all of these interesting internet retailers started popping up that were focused more on group buying and social buying and that kind of thing. I'm referring to companies like Groupon and Living Social and Woot and Tenga and OneSale, No More Rack. There were a lot of them at the time. That industry has definitely been consolidated, and a lot of those companies have actually gotten hurt over time. But what I noticed is there's all these interesting internet retailers starting up that are following more of a social group buying kind of model, where they have 24-hour sales and they have maybe a few products for sale that they're selling in super huge volumes. And what I noticed was these companies were raising tens of millions of dollars, in some cases hundreds of millions of dollars, from VCs. And they were spending the majority of that money on customer acquisition cost. And if you remember earlier, we talked about how much I hate spending money on customer acquisition cost because of the risk and the loss leader and all that kind of stuff that comes with it. So what I noticed was this was a great leverage point. You know, if I could figure out how to get partnerships with these companies, they had 10, 20, 40, 50 million dollars in the bank, in some cases more, from VCs, and they were willing to spend whatever it took to acquire customers. And the key thing here is they were willing to spend that money whether they were profitable on it or not. And in almost every single case, with one or two exceptions, but in almost every single case, they were not profitable, meaning they were going out, they were buying customers, buying traffic to get customers, and they were not making money on that customer. In fact, in most cases, they were losing a significant amount of money. So they were basically, it was almost like a black hole where they were draining money to acquire customers. And so I noticed that. The other thing I noticed was they weren't really set up with a traditional e-commerce foundation. A lot of them had no warehouse space. They had no background in purchasing. They had no background in internet retail. They had no real foundation as far as infrastructure and staff and warehousing and inventory that a traditional internet retailer would have. So that was the opportunity. The opportunity was twofold. One, we can leverage off of all these companies that have raised hundreds of millions of dollars in VC money, and we can let them go out and acquire the customer. We can let them lose money on the customer acquisition cost. We can let them do all that work because that's their model and they're willing to do it. And the other opportunity there was they didn't really have traditional internet retailer infrastructure and foundation and all that other kind of stuff I talked about. So if we could go in and provide them with that foundation and provide them with that infrastructure and almost form a partnership with their platform, there was clearly a blue ocean there, meaning there's a huge need that these companies had that wasn't being met, and they had the money to do the customer acquisition side. So that's exactly what I did. I set up ClearSpark, and we started importing product from China, and we started branding product. We basically did everything for them. So I'll start from the beginning. We would import the product from China. Well, even before that, we would identify the products that would sell well on these platforms. We would then approach factories in China. We would work with them to develop these products. In some cases, we would private label them. Then once we imported the product, we'd put our own branding on them. Then we would work with the e-commerce companies. We'd form partnerships with them. The approach was, look, we will stock the product for you. We will ship the product for you. We'll do the customer service for you. And then we'll pay you a fee for every product that sells right off the top. And you have none of those headaches. So we worked with third-party fulfillment centers and we built out this whole infrastructure. And that company grew very, very quickly, mainly because there was a blue ocean and that need was there.
So this sounds very different from ZQ Network, right? What was the ClearSpark business model?
You're right. It's quite different from ZQ Network, not completely different. I'll tell you the similarities and the differences real quick. So the similarities are they're both internet companies. They're both in the e-commerce space. They're both built around physical products. Those are the similarities. The differences, while ZQ Network was direct to consumer, so it was a B2C company, we shipped directly to customers. Customers bought directly from us. It was a one-to-one relationship, and we had tens of thousands of customers that we directly worked with. So 100% B2C. We did not really sell to other businesses, generally speaking, with a few exceptions. But generally speaking, it was directly to customers that we were selling and working with. With ClearSpark, it was directly the opposite. So we worked with zero customers. In fact, we didn't really have much of a web presence or storefront or anything like that because we weren't working with customers at all. All of our clients were other businesses. The e-commerce websites that I mentioned, those were our customers, those were our clients, and it was 100% B2B. We had almost zero interaction with customers with the exception of customer service. But with the exception of customer service, customers, consumers, I should say, didn't even really know who we were because everything that we were shipping, we were the drop shippers almost in this case because everything we were shipping had the client's name and logo and branding and return address on it. We were kind of excluded from the picture completely. The core business model for ClearSpark was 100% B2B. So it was working with all of these large internet retailers, forming partnerships with them, and basically providing them all the infrastructure that they needed. And a typical model might go something like this. We've identified a great product. It is a kitchen accessory. And here's the branding that we've put on it. Here's the price that we need for it. And here's how much we're willing to pay you for each one that sells. Here are the creatives. Here are the graphics. Here are the specs. Here's everything you possibly need to know, and here's the full package. Would you like to list it? And we would negotiate deals with these large internet retailers. If they said yes, then they would list that product on their website without mentioning us. Again, ClearSpark was never mentioned. It was all about the internet retailer. We were just a background third-party kind of partnership with them. So then they would list it, and let's say they sold 20,000 units. Well, then we would get names, addresses, email addresses, phone numbers, shipping addresses, etc. of those 20,000 customers. And it was our job to then have the infrastructure in place to import 20,000 units and to ship 20,000 units and to send tracking numbers to those 20,000 customers and to do customer service for those 20,000 customers and make sure that the internet retailer was happy. And we basically did this over and over and over again and moved hundreds of thousands of units of product. And we had partnerships at our peak with roughly 20 different internet retailers. So pretty much anybody that was a sizable player in this social group buying kind of model, we had partnerships with them, and we were working directly with their buyers and using our infrastructure and all of our resources to do that. And that was basically the ClearSpark business model. Ended up exiting that with a private equity group out of Chicago. That business grew really, really quickly, and so the approach was almost backwards. Whereas with ZQ Network, I had to go out there and see if there were any interested buyers. With ClearSpark, it was the opposite. The buyer came to us through a broker introduction, which was, quite interesting, and it was my opposite of my experience with ZQ Network. And ended up exiting that, and that was the core business model for ClearSpark.
I'm not going to ask if you took any time off after selling ClearSpark. I think I already know the answer. So after having 2 exits, what are you working on these days?
You are 100% correct. I think you do already know the answer. So these days, what am I working on? I'm working on a couple different things, actually. So it's 3-4 different things that I'm working on. The first thing is, most of my time these days is spent investing in distressed equities. I kind of mentioned that earlier, but I see lots of opportunities in the market, the equity markets, with a lot of distressed companies that have great business models. They have great foundation. From an analytical perspective, they're great, but the market is down on them temporarily. That's kind of the inefficiency that I see. So, a great company that has great EBITDA, great margins, great history, great return on invested capital, meets all of the traditional criteria that investors look for, but the stock has gotten really beaten down because, let's say, they're going through a temporary crisis, or they're going through management changes, or they have some type of other issue that, while it's affecting the stock price and it's affecting the cash flow and it's affecting the margins in the short term, I see that as almost a temporary blip and something that they will be able to recover from. Now, of course, I don't really buy these companies on a one-off kind of basis. It's more of a quantitative model in the sense that, the risk is diversified. So if you buy 1 or 2 of these, some of them go completely bust. That means they don't usually go to zero, but very quickly do they fall apart. So I'm buying them on a diversified basis, and the upside is the market is so down on these companies that it's really an asymmetrical risk reward kind of opportunity. And if you notice in previous ventures that I've been talking about, I've always looked for asymmetrical risk reward, which basically means that your downside is pretty limited, it's pretty protected, and you can't go much lower. But if it works, your upside is great and is almost limitless. And those are the kind of characteristics I'm looking for in a equity type of investment. So a typical company might be a company that has, again, had great cash flow, great profits, delivered great returns to shareholders, has great returns on invested capital. But let's say they're going through a temporary crisis and the stock falls apart by 50%. Well, the market is really down on that company. I think they're going to bounce back. I think there's a good chance they're going to bounce back. And we look at, best case and worst case scenarios. So worst case scenario is, well, how much lower can the stock really go? The stock's been beaten down 50%. It might go down another 5, 10, 20, 30%. Could go down more. I really don't know. But the typical analysis with one of these companies, before I invest at least, is the stock's not going to go down too much lower. That's generally the thesis that I want to see before I invest. Whereas if it's not at an all-time low, it's close to an all-time low, or it's approaching that all-time low. And I don't really think it's going to go much lower from here based on whatever crisis they're facing. So that's one thing. The second thing is the upside. So best case scenario. So let's say they bounce back and the market is not expecting them to, obviously, as reflected in the stock price. But if they happen to bounce back, which again, all the stuff is analyzed, so it's not like I'm just blindly investing in these companies. We're looking at the downside. We're making sure the downside's limited. We're making sure the stock is not going to get beaten down too much more, that the market is kind of fully priced all this stuff in. And then we're looking at the upside and saying, okay, if the company does bounce back and get through this crisis, which we are pretty confident that they will, what's the upside? And the upside might be a 70, 80, 100% jump in the stock over the next, call it 12 to 24 months. Now, that sounds pretty dramatic, but the reason returns like that are possible on any given stock is because the market is very, very depressed. Buffett has a great quote on this. He says, "Be fearful when others are greedy, and be greedy when others are fearful." So essentially, we're looking for companies that others are very fearful about, because the price that you pay is a reflection of how much risk that you're willing to take on. So if you pay a really low price for a company and it's a great company and they have good assets and they have good history and it's a temporary crisis, your risk, generally speaking, is pretty limited in situations like that. Very much akin to the Carl Icahn kind of model, except we're not activists. We're not going in there and doing proxy fights and filing 13Ds or anything like that. We're just passively doing this on a quantitative basis. So that's what I spend most of my time doing these days. The other thing that's been really interesting is getting approached quite a bit for brokering opportunities. So I've only done a handful of these, but basically brokering transactions for other entrepreneurs that want to exit their companies as well. So that's been really interesting. And then the other thing that's been very rewarding actually has been consulting. So I've been working with a lot of different large companies that are in the internet space or want to get into the internet space and want some help as far as how to go about doing it, whether it be scaling their business, growing it, entering a market, working with companies like Organize.com, Where's Direct, Z Prepay, and so forth, in helping them set up their online models and making sure that I'm being as helpful as I can with my experiences. So consulting has been not only very rewarding, but very fulfilling as well, because I can see the impact that it's making and I can see the value that it's driving in other entrepreneurs and other companies. And again, I'm always looking for new ventures to jump into and new opportunities, but those three things take up the majority of my time. And then if I have any time left, I'm looking for new deals and new ventures and a new startup to jump into.
Very cool. That's pretty exciting. So this next question is to benefit our listeners that are thinking about taking the entrepreneurial leap. What has been your overall approach and model to digital startups? And what advice would you give to fresh entrepreneurs just getting started?
Great question. And I think this is a question that I could talk about for literally hours and hours, but I won't go on for that long. I'll try to summarize it. Some of the answer we've already kind of talked about. Other parts of the answer might be kind of new to our conversation. But as far as the overall approach goes, It's very simplistic. It's just a combination of a couple things. The first one being, I have no interest in reinventing the wheel or coming out with some new invention or some new innovative thing that no one's ever heard of and I'm going to revolutionize the world or something like that. That kind of thing just doesn't sit well with the way my brain is wired. Now, that might not be great advice to every entrepreneur out there, because there have been very, very successful entrepreneurs that have done just that. I mean, one entrepreneur that comes to mind is Elon Musk, with what he's done with Tesla and all of his other companies, right? Super innovative, super inventive, stuff that nobody's really done before. He's way smarter than I am, and that's just not the way my brain's wired. The way my brain is wired, and again, I think self-awareness is key. So I think every entrepreneur has to decide this for themselves. Are they self-aware enough to decide which one of these categories they belong to? The category that I belong to is basically looking at other successful models, whether it be other successful companies or entrepreneurs, looking at what those companies are doing, really doing my homework, really understanding their model, what's making it tick, what's making it go, what are the key parts to it, and what are the key driving forces behind that model. So everything from marketing to product to service to infrastructure to the team, basically understanding all those driving forces behind a business and then seeing if I can do it better, or put my unique twist on it, or just take some market share. That's basically been my overall approach. As far as specifics go, it's been the stuff that we've already kind of touched upon. So it's looking for low risk opportunities, low customer acquisition cost, internet-driven business models, high profit margins, the ability to scale, exiting the company when I think the time is right, and basically working really hard and putting all those pieces together has been the overall approach. I wish I could make it sound more sophisticated than that or add some type of elegance to it, but it's quite simplistic as far as approach goes. Now, what's not simplistic is when you're trying all of these different models and they're not working, and that's where experience comes in. So now when I work with consultant clients and other entrepreneurs that approach me and need help and that kind of thing, I can bring that experience and kind of, almost say, I've tried this, I think this is not going to work, and I think this is going to work, and I think this is where you should start, and this is what you should do next. So that's where the value comes in for consultant clients and other entrepreneurs that approach me and that kind of thing. But the overall approach is pretty much what we've already talked about, and it's working on a combination of those things. As far as advice I would give to fresh entrepreneurs, it would be a combination of things. So the first thing is, are you really an entrepreneur? Do you have that self-awareness? Right now, it's super cool to be an entrepreneur. There's TV shows about it. There's movies about it. Everybody's talking about it. It's the cool thing to do. And I mean, I'm not here to knock anybody, but what I've seen is a lot of people jumping into entrepreneurship that aren't really entrepreneurs. They'll be happier, they'll be better off, they'll be more fulfilled, they'll be more successful doing something else. But they're letting society and what's cool, what's fashionable take over their what they want to do with their life. But, that's more of a philosophical question. I'll leave that to each individual person. That's where self-awareness comes in. So the first thing I would say is be self-aware and figure out, is this what you really want to do? Or are you just doing it because it's the cool thing to do and it's the hip thing to do? Back when I was starting out, it definitely wasn't the cool thing to do. In fact, nobody was really even talking about entrepreneurship. No one even really used the word entrepreneurship that much back then. It was just called being a businessman. So the first step would be self-awareness. And then the next steps are pretty self-obvious, but I'll point them out. It's hard work, dedication, being focused, having a good business model, not giving up, but at the same time being open-minded and being able to pivot, and going into markets that meet the criteria that we've already talked about. Low risk, low competition, low customer acquisition costs, ideally high barriers to entry, ideally limited competition, ideally the ability to scale. All of those things are super important for entrepreneurs to keep in mind. And then just working super hard. I've never had much of a balanced life, and if fresh entrepreneurs just getting started think they're going to have a super balanced life, I would say you might want to rethink if this is for you. But if you're focused, if you're driven, if you're self-aware, if you're okay with not having balance, if you model after a company that's already working and you really do your homework, and then you go out there and you try out one approach, it doesn't work, you try out another approach, it doesn't work, and you keep learning from your mistakes and figuring out why it's not working and figuring out what you need to do to improve or change, and seeking out experts that are really good in whatever you're trying to do and getting their feedback. And if you literally just keep doing that, you really can't help but be successful. I mean, throughout this podcast, we've talked a lot about the various successes and so forth, but it's really important to not get carried away with those. It's important to keep in mind with each of these ventures, there were a lot of different mistakes and headaches and approaches that didn't work, and a lot of retuning and a lot of going back to the drawing board and figuring out what I did wrong and fixing that and trying a different approach. I mean, there were tons of stuff like that, but if you can literally just keep following this process that I've laid out and just keep going at it, eventually you literally can't help but be successful, because eventually you'll get it right. May not be the first, second, or third time, but eventually you will get it right. It's just a matter of pushing on until something clicks. And once it clicks, then you'll be pretty surprised by how fast things take off. But I would say if you keep all of that stuff in mind and follow that overall approach, that would be my advice to fresh entrepreneurs that are just getting started.
Thanks for the detailed answer. I think that's a great place to leave it. I've really enjoyed our conversion. Thank you for your time. I appreciate it.
Thank you so much, Chelsea, for having me. I've really enjoyed our conversation, and I've really enjoyed some of the questions you've asked and taking me back through a trip of memory lane almost. I sound really old when I say that, even though I'm not. But I've really enjoyed the conversation as well. Thank you for your time, and have a good day ahead. Bye-bye.